Just how did you react when you saw that number roll across the Bloomberg terminal?
I think it takes more than 45 minutes to actually to assimilate all of what it's telling you, but it's pretty remarkable. I mean, we had some sense that the economy was improving. You see it in all the high frequency data we look at, from some of the industrial data to the trucking data, et cetera. But this just shows you the economy's coming back faster on an employment basis that anybody could have anticipated. And, particularly when you see leisure and when you see what's happening in, what falls into that in restaurants, et cetera. I mean, that, you have a sense that it was going to come back, but pretty powerful in terms of how quickly the rehire is taking place.
Well, Rick, that was what it was always going to come down to as we reopen, not just the direction of travel, but the rate of change, how quickly we improve. Mohammed and I were talking about this, just knocking it around 10 minutes or so ago, how quickly we can keep this rate of change up, how long we can keep doing this month on month on month on month. Do you see it in two speeds, in two stages? Yeah. Do you see it as a seamless journey? How do you frame it right now?
Yeah, it's a great question. Well, first of all, I mean, like I said, I think I think you have to anticipate the economy was going to come back quicker, particularly with some of the better numbers around the virus. That being said, I think you made a great point, by the way. Markets tend to anticipate faster than the economy moves. And particularly, you think about how the Fed thinks about their impact on long and variable lags. Well, the market doesn't think that way. It thinks in where we're going. Listen, I think this is moving the speed up a bit faster, but we've been pretty enthusiastic. The data is impressive, and what you'll see is this restocking that's taking place, which will be beneficial for pricing power. You'll see that in some of the inflation numbers that'll start to be better as you get the inventory, and not just inventory destocking, but now you're going to get an inventory rebuild. So I do think you're going to get better numbers persistently, but maybe this is a bit faster than I would have even thought. It means next couple of months you won't see that rate of acceleration of employment you otherwise thought you would have, but the data is going to continue to be pretty solid, we think.
Well, Rick, every day that goes by without another pickup in infections, as this economy continues to reopen, people will have more confidence to go into the riskier parts of this market, the more cyclical parts of this market. How do you maintain discipline in a moment like this one, Rick?
So that is a great question. I mean, we've been on your show talking about it for a while now about, you got to run balance in your portfolio, but take some equity risk. And, now as the markets are running up so much, there's some other ways you think about it that, gosh, don't put all your eggs in one basket. I do think the equity market will continue to go higher. The cash is too high. People have missed it to some extent, and pension funds and endowments, et cetera, have no choice because rates are so low. So we'll keep grinding up. But I think you got to think about other expressions around the world. And Jonathan, I've been on your show for I don't know how many years. We've talked about Europe. That we haven't seen a catalyzing event in Europe in terms that would promote the ability to buy equities because we've been in this negative rates, and all of a sudden fiscal stimulus, Eurozone recovery. I actually think diversifying globally makes some sense now. And for the first time in a really long time, you're actually getting the appropriate policy in Europe, which means you can actually take some of these expressions in other parts of the world and not just bet on the U.S. recovery.
Well, Rick, we're hearing the right things from Europe. I just wonder if they follow through in a real way in the next coming months, the next year or so. There is a big difference, though, between a tactical trade to go out into Europe and pick up on that cyclical theme, where Europe is considered to be a deep cyclical, and something much more sustainable than that. Which one is it at the moment for you?
So I agree. So I don't think you're going to see rip-roaring growth in Europe, but I do think when you look at some of these markets, Jonathan, in Europe and how the markets have really gotten hurt, and if you said, and particularly in places like Italy or Italy and some of the other, Spain, et cetera, that if you said, gosh, you were going to have, if you went back and said, where should the markets be today relative to where we were 3 or 4 months ago? Well, if I told you, gosh, we're going to have a virus that's going to shut down the economy for a while, but it's going to lead to maybe some fiscal and maybe some structural change. How much should the markets be down? And I would argue that actually you may arguably be in a somewhat better spot from a market's point of view. So I don't think you're going to be, I think it's, as you said, more in the tactical, gosh, the markets have really gotten hurt. You should retrace some of that. You've got a better structural dynamic than it is, gosh, I'm expecting tremendous growth in Europe because you don't have, as we talked about, the technology drivers and some of the other drivers that create real growth in the region.
Rick, let's talk about a fixed income side of things and move away from equity just for a moment. Just a phenomenal number in this market that's going to give a lot of people some confidence about the recovery. And we all hope it continues on this trajectory, though I understand that many people watching will have their doubts quite naturally. You've made the argument in the last week that risk-reward still favours the medium and high-quality spread. Is that still the argument for you at the moment?
Yeah, I mean, I still love. I think you're going to have a high default rate in the over the next few months, and I think you'll still see the weaker parts of the economy that still are too levered and can't experience that bounce back. That being said, middle quality income, we've talked a lot about that, and places in high yield, and it's very hard to say whether they're rated today as opposed to what sector they're in. But that middle quality income and spreads. Gosh, there's not enough yield in the world, Jonathan. Even if you get a few more basis points on treasuries, it's still nothing. That I still think that's, as you talked about, equities have run up a lot. I still like buying that income, and particularly, to outperform treasuries and other risk-free rates. So, I'm still there. Can you go a little bit further into some of the riskier parts of that market? I think so, and not just in the high yield, but some of the securitized asset classes. Particularly after a number like this, it gives you some sense the economy's bouncing back a bit faster.
Rick, I wanted to wrap things up by talking about that Amazon issue that came out earlier this week, because it was absolutely phenomenal to see that 3-year paper at 40 basis points. That's what got the headlines. What I thought was more interesting was what happened further down the curve. To see a company like Amazon in the tech sector price 10, 20, 30, 40-year debt, 40-year paper. Rick, talk to me about the longer end of the curve and the risk being taken with some of these companies that are safe right now, where the short-term paper and where it's priced might make sense, but the risk going further out, further down the curve. Yeah,
John, you always tend to highlight the important things. So Amazon, to me, was an incredible cathartic moment where they were able to price. I mean, the 3-year came at 40 basis points. Funding a technology company, by the way, it's one of the interesting points in time where everybody can get a deal, meaning that spread is pretty reasonable relative to the treasury, and particularly longer on the curve, as you say. Funding some of these levels are pretty aggressive. Longer on the yield curve, you're getting the levels now that are starting to be pretty interesting, and I think you'll see particularly pension buying at some of these yield levels. But I think, quite frankly, funding some companies 5 years in at levels that are less than 0.5% or 50, 60 basis points. You think about, I'm an investor. If you're thinking about investing, how much return are you going to generate from that? Whereas you could buy their equity, and we've got free cash flow generation that is significant. So I think when you think about balance in a portfolio, I thought that deal, when I looked at it and I said 40 basis points, it seems on particularly 3 years, it hit me. And I looked at it, I said, oh my God. But then I thought, actually, it's not bad. If you're just a credit investor, you can hedge the interest rate duration. So, but it gives you an exactly perfect viewpoint on where we are today. And by the way, that the Fed is going to keep rates reasonably low for a while. And, the benefit to where you can take advantage of that in spreads and risk assets.